Let's continue our discussion of cash and savings by talking specifically about checking and savings accounts. So a checking account is actually what's called a demand deposit. What that means is you're depositing your funds in this, remember, depository institution. And that gives you the right to demand your money at any time. And so you can demand that money by writing a check, by going to the ATM machine, or visiting a teller. And so if you have the funds available in your account, if your deposits are enough to cover your demand, then that bank must pay you. Now, a savings account is actually a time deposit account. And so the expectation is that you're going to leave that money in a little bit longer. So a checking account is more short-term, on demand. A savings account is considered more long-term. And so that's why you'll notice that many banks and savings institutions will limit you to a certain number of withdrawals from a savings account, and after you reach that limit, you'll start incurring fees or penalties because that money is supposed to stay there a little bit longer. That's why they're paying you a higher interest rate. So now let's talk about types of checking accounts. Regular checking accounts are offered by commercial banks. Remember, they're the ones who can offer a non-interest paying checking account. And so that's what we consider a regular account. Now, an interest-bearing checking account is offered by many more financial institutions. And they take on kind of different names and slightly different features depending on which type of institution is offering that account. But the common feature is that they pay interest. So different types of account. A NOW account pays interest but may require a minimum balance. A money market deposit account, federally insured. I mean, all of these are going to be very similar. And again, the main difference is going to be which institution offers which type of account. Now, an asset management account is typically for people who have a little bit more cash that they need to manage. And so these accounts typically offer comprehensive services. So you can have checking and investing and borrowing features all bundled together. And so it usually includes that MMDA, the money market deposit account, that gives you unlimited free checking. You can write as many checks as you want. A debit card, use of ATM cards, lending. It may be tied or linked to a savings account or a brokerage account at your discretion. Because again, this is, the idea is to kind of give you full service cash management, full service cash management product. So again, getting back to these different types of accounts and where they're offered. So we have, this may be a little bit confusing, the MMDA, which we just talked about, and then money market mutual funds. An MMDA is offered at a depository institution and is federally insured. That's going to be the key difference. Typically requires a minimum balance, but you can write checks. On a money market mutual fund, that is typically offered through a brokerage firm. And so you're not going to get that federal insurance. Pays, interest rate kind of varies over time, but most of the time these money market mutual funds pay a higher interest rate compared to just a regular savings account. And then you get the convenience that you can write checks. So for some folks, a money market mutual fund makes more sense, especially if you're holding higher balances, because you get more interest than just having a regular checking and savings, but you can do both. So now let's talk about electronic banking. These days, I don't know many people who don't use electronic banking services. So these are ATMs where you can just go and get cash, debit cards where you can make purchases using a piece of plastic, but it's not related to credit, it's related to your bank account. And then pre-authorized deposits and payments. So you're telling your creditors, go ahead and take that money out of my account when that bill is due. Banking by phone, online banking, all of these are services that kind of make life a little bit more convenient when it comes to managing your cash. And so how all of this is done and the speed with which the transfers are made and errors are reported are governed by certain regulations. And so electronic funds transfer is, or these services, is governed by this Electronic Funds Transfer Act of 1978. And so it says if there's a mistake, it has to be reported within 60 days. And so what that does for you, it limits your losses if you immediately report any kind of theft or unauthorized use of your credit card. So as soon as you find out that a card is missing or you see transactions that you're sure that you didn't make, you've got to report that so that you won't be liable and you could potentially get all of your money back. So other services that banks offer, safe deposit boxes. And so this is, you see the picture, it literally is a box that's held at your bank, and we recommend using a safe deposit box for valuables that you want to keep out of your house in case of a fire or some sort of disaster. So these would be maybe passports, wills, birth certificates. But one thing that you have to remember, especially in the Southeast, is that most of the time these safe deposit boxes are not waterproof. So don't put something irreplaceable in a safe deposit box. Another service that a bank can provide is trust services. And so that provides help, again, oftentimes this is more for wealthy clients, but with estate planning. And actually you don't really have to be super rich to make use of trust services if you just don't want to have your money dictated by the state after you're gone. So some things to think about when you're using a checking account. There are all kinds of fees related to checking accounts, and so you want to make sure that you're minimizing fees, or at least you're not engaging in the behavior that's going to cause you to incur a fee. And particularly for students, check out the student accounts. Typically those have no fees. They don't have a whole lot of services, but students usually don't need a lot of services. So think about, do you need an individual account or joint account? Joint accounts aren't just for married people. Sometimes students will use a joint account with a parent so that the parent can make deposits into the student's account. We need to know a little bit about how the checking account works in terms of procedures, what happens if you write a check for more than you have in your account, and what happens if you need to stop payment for whatever reason on a check that you've written. And I know most people don't actually write paper checks anymore, but you need to know how that works in case you do. There are some special types of checks, and these are checks that you probably will only have to use a few times in your life maybe, but you need to know how these work. Sometimes you might make a purchase and the seller says, well, I only accept certain types of payments, and one is a cashier's check. Typically when you buy a house and you make a down payment, at the time of closing, they say you have to bring a cashier's check or a certified check. So how do you get those? Well, you go to your bank, and you have to have enough money in your regular bank account to cover the check, but you ask them to make you a cashier's check or make you a certified check so that you can take to closing. Cashier's checks and certified checks are very similar. Sometimes certified checks tend to be a little bit more popular because it's guaranteed by the bank, but in both cases they are, well actually, let me explain the specific difference. Both cases you have to go to the bank and ask them for this check. You can't write a cashier's check or a certified check. With a certified check, it's you write the check and then the bank certifies it and says, yes, the money is there. With a cashier's check, and actually that tends to be the one that is preferred for a mortgage closing. With a cashier's check, the bank takes the money out of your account, puts into their account, and then they write the check. So that gives sellers a little bit higher comfort level that this is being written by the bank, so this check is not going to be turned down. And then traveler's checks, those are, I guess, similar but very different in terms of how they're used. Those are what some people get when they go on vacation. So you go to the bank. Again, none of these checks are checks that you can just write and do something on your own to make them have this designation. For a traveler's check, you go to the bank and you say, take $1,000 out of my account and give it to me in traveler's checks. So then you can use those just like cash anywhere you go. The benefit of using a traveler's check is that they can be replaced if they're lost or stolen, unlike cash if you're traveling. So remember, we were talking about checking and savings. You really, really, really need to have a savings program. So some things to think about. Pay yourself first. One of the things that I typically talk about is that there's 3 things that we can do with money. We can spend it, we can save it, and we can share it. And you need to think early and often about how much of your money you want to spend, save, or share. And so actually, it's not a bad idea to think about the saving part first. So that's what we mean by paying yourself first. As soon as you get paid, first take out a percentage for savings. That's paying yourself. Then you can share some, but by that I mean, donating, and then you can spend some. So one way to pay yourself first is on payday. Just go ahead and take that money out and put it into a savings account, or even better, have it done automatically. And so we do all of this because we need to have an emergency fund of at least $1,000. We need to set aside money for things that we're working toward besides emergencies. So direct deposits are great ways to do this. And then you've got to think about, okay, I'm going to pay myself first, but do I just put it in a regular savings account? Do I put it in that money market mutual fund that I can write checks off of? But that's going to be a choice that you've got to make depending on the reason why you're saving and what all of the savings options are. So when you're saving, you want to understand the interest that you're earning on your savings. Most places don't pay simple interest anymore. Simple interest is if you just get interest on your deposit. Instead, you're going to get compound interest. If someone's not offering you compound interest, walk away quickly. Compound interest means that you're going to get interest not only on your new deposits, but on your old deposits too, which means you'll get interest on interest. So some terminology with interest, because these get a little bit confusing. The nominal rate is the stated rate that the bank tells you. So if they say our interest rate is 8% compounded quarterly, 8% is their nominal rate. The effective rate is what that nominal rate really turns out to be once you factor in compounding. So the more frequently your interest is compounded, so monthly would be better than quarterly and daily would be better than monthly and so on, the higher, so that more frequently it's compounded, the higher the effective rate. So remember, if it's simple interest, there's no compounding. So the interest is the principal times the interest rate times the amount of time. So if we have $1,000 in principal that we have saved at a 5% interest rate for a year, we're going to end up with $50 in interest. So now, if we're getting compound interest, then after 6 months, we're going to get $25. And then the second 6 months, though, because we're earning interest on interest, we're going to get $25.63. So total, is $50.63 as opposed to just $50 with simple interest. So this kind of shows you the magic of compounding, meaning as our interest rate goes up and our compounding frequency goes up, you see that the effective rate is going up. So I'm just proving to you the point that I made earlier about effective interest rates. So again, our nominal rate was 5%, but our effective rate was higher at 5.063%. Because if you take the $50.63 in interest and divide it by the $1,000 in principal, we get 5.063% as an effective rate. So how much interest you earn depends on, we've said all this already, how frequently interest is compounded, the balance on which our interest is paid, and the interest rate that we're being paid. And so all of this is kind of explains in a way the time value of money. The time value of money ties those three concepts together. So you've all different ways to save, just like we had a lot of different checking options. Certificates of deposit, treasury bills. Remember back in the beginning we talked about liquidity. These are going to be a little less liquid than just a basic savings account, because in order to access or convert these accounts into cash, it won't be as easy as just going to an ATM. So savings bonds, we purchase them at a discount and then they actually mature or increase in value to eventually reach their face value. And so there are some tax benefits by using savings bonds. I know not many people use them anymore, but they're still out there and they're still a decent way to save, especially because of the tax benefit.